Every single day, money moves. Not in ways most people can see, but in ways that are carefully designed, deeply embedded, and almost impossible to escape. While the average person works 40 hours a week, pays taxes, services debt, and saves whatever is left, the financial system quietly shuffles wealth upward, toward those who already have the most of it. This is not a conspiracy theory. It is a documented, measurable reality backed by decades of economic data. The gap is not growing because the rich work harder. It is growing because the system itself is built to move money in one direction, and most people have no idea it is happening. So today, this video breaks down the exact mechanisms behind that transfer and why understanding them might be the most important financial lesson most people never learn in school. The hidden cost of everyday money. The first place the transfer happens is so ordinary that most people never question it. It happens every time someone gets paid, spends money, or takes out a loan. Start with inflation. When central banks print money or lower interest rates, the value of existing cash slowly erodes. The people hardest hit are those who keep their savings in a regular bank account, mostly middle-class and working-class households. Meanwhile, those who hold their wealth in stocks, real estate, and hard assets actually benefit from inflation, because the value of those assets rises while the real cost of any debt they carry shrinks. This is not accidental. This is the built-in design of a debt-based monetary system. Then there is interest. The average credit card in the United States charges somewhere between 20 and 25% annual interest. Payday loans can climb far higher than that. The people most likely to use these products are those with the lowest incomes and the fewest alternatives. Every month they carry a balance. A portion of their paycheck flows directly to the financial institutions that issued the card. Those institutions, in turn, pay their shareholders, who are disproportionately wealthy individuals and institutional investors. So the financial struggle of the working class becomes the investment income of the ownership class. Consider what happened during the 2008 financial crisis. Banks had been issuing risky mortgage loans to millions of ordinary Americans. People who were told they could afford homes they ultimately could not. When the market collapsed, those homeowners lost their houses, their savings, and their financial stability. The banks, however, were bailed out with taxpayer money. Losses were socialized. Profits had already been privatized. The people who created the crisis largely kept their bonuses, while families across the country lost everything. Economists like Joseph Stiglitz argued extensively that this dynamic exposed
bubbles allowed everyone to live beyond their means. And that was one of the reasons the regulators didn't want to do anything. There was a party going on and nobody wanted to be a party pooper.
just how deeply the financial system protects the wealthy at the expense of everyone else. Even wages themselves reflect this transfer. Productivity in the United States has risen dramatically over the past 50 years. But wage growth has not kept pace. The gap between what workers produce and what they are paid has widened every decade, while corporate profits and shareholder returns have exploded. The difference between those two lines on a chart is wealth that workers generated but did not receive, wealth that flowed instead to business owners, executives, and investors. How the tax code moves money upward. The second major channel of wealth transfer is the tax system, and this one is hiding in plain sight. In most developed countries, wages are taxed at higher rates than investment gains. Someone who earns a salary of $200,000 a year will pay a higher effective tax rate than someone who earns that same amount from dividends and capital gains. This structure means that the more wealth a person already has, and therefore the more likely they are to earn through investments, the lower their overall tax burden relative to income. Warren Buffett famously pointed this out when he revealed that he paid a lower effective tax rate than his own secretary. He was not bragging. He was highlighting a structural absurdity that few politicians have ever been willing to seriously address. Inheritance laws compound this further. Massive estates are passed down across generations through trusts, family offices, and legal structures specifically designed to minimize tax liability. Ultra-wealthy families rarely transfer assets outright. Instead, they use offshore trusts, stepped-up tax bases, and gifting strategies that allow trillions of dollars to change hands with minimal reduction. Meanwhile, a working-class family that manages to save a modest home and pass it to their children may face taxes and legal costs that erode much of that legacy. Elon Musk, Jeff Bezos, and other billionaires have famously maintained low taxable income for years by taking loans against their stock holdings rather than selling shares. Loans are not income, they carry no income tax. The stock appreciates, the billionaire borrows against it, leves off the loan, and the tax event is perpetually deferred. This is not illegal. It is the system working exactly as written for those with enough wealth to use it. Corporate lobbying ensures the code stays this way. Large companies and wealthy individuals spend billions each year on political contributions and professional lobbying to protect the tax structures that benefit them. That investment pays enormous returns. The Walton family, heirs to the Walmart fortune, has used legal structures to preserve one of the largest family fortunes in American history across multiple generations.
I think the charter sector has demonstrated that there can be hope, there can be opportunity, there can be high-quality education provided within.
Wealth that originated with workers earning minimum wage in stores that have consistently fought against wage increases. The asset ownership gap that grows every generation. The third and perhaps most powerful mechanism is the simplest: those who own assets keep getting richer, and those who do not own assets keep falling further behind. Stock market wealth is extraordinarily concentrated. The top 1% of American households own roughly half of all stocks. The bottom 50% own almost none. When the Federal Reserve cuts interest rates and markets surge, as they did dramatically between 2009 and 2021, the primary beneficiaries are those who already hold the most financial assets. The policy that was marketed as economic stimulus was, in effect, one of the largest wealth transfers in modern history. Asset prices inflated, and the gains went almost entirely to those already at the top of the distribution. Real estate follows the same pattern. People who owned property in major cities over the past 2 decades have seen staggering gains in net worth, simply by holding what they already had. Young people attempting to enter the housing market today face prices so elevated that home ownership, historically the primary vehicle for middle-class wealth building, has become out of reach for millions. This locks an entire generation out of the asset appreciation cycle and forces them to pay rent, which builds the wealth of the landlord class instead of their own. Education, too, plays a role. Wealthy families send their children to elite schools that provide networks, credentials, and opportunities unavailable to most. As one major study found, more than 60% of the Forbes 400 richest Americans grew up in environments of significant financial privilege. That is not evidence of a meritocracy. That is evidence of a system that compounds advantage across generations. The total scale of this transfer is breathtaking. Baby boomers and the generation before them are estimated to pass down over $84 trillion in assets over the next 2 decades. Nearly half of that enormous sum will flow through the wealthiest 1.5% of households. For the majority of families with modest savings and no significant investment portfolios, their share of this generational transfer will be comparatively negligible. The financial system does not need to announce what it is doing. It does not need to be loud or visible. It operates through interest rates, tax codes, asset markets, lobbying, and legal structures that most people never study and few governments have the will to change. Every payment on a high-interest loan, every hour of labor that outpaces wage growth, every stock market rally that benefits those who already hold shares, these are not random outcomes. They are the predictable results of a system designed with a specific direction in mind. Understanding this is not about bitterness or resignation. It is the first step toward making smarter personal financial decisions, demanding better policy, and seeing the world with clear eyes. Because the system will not explain itself. That job, ultimately, falls to the people who live inside it.